Hey guys, and welcome back to the Young Investors Podcast. We're up to episode 30. We've hit another milestone here. It's not really a milestone, is it, though?
We'll call everything a milestone. We'll say that next week as well. Episode 31. Oh, what a milestone. 31 is such a special number to me.
Oh, yeah. No, it's been good. How have you been?
Been going all right. Busted my knee up pretty hard during the week, but that's all right. And we're both battling a bit of a cold at the moment. But we're still here. We're still fighting. We got a lot of earnings to talk about today, which is going to be good to go through. It's always good. Yeah. I love this time. This kind of time each quarter where you just get heaps of new information about all the stocks that you follow. It's good. I've been listening to conference calls like a madman. Been reading reports like a madman. So it'll be good to go through them.
Yeah, absolutely. And as always, we're going to start off with the indices. We'll go through the indices. We've got a couple of news stories that are sort of related to earnings anyway. But then in the middle section, the main section of the podcast today, we're going to go through a bunch of the major companies that reported earnings this week. And I guess we'll probably be doing a similar thing next week as well. So if you have any companies that are reporting next week or after this comes out, then make sure you leave them below the YouTube. Leave them in the comment section of the YouTube video so that we can cover them. But did you want to take us through the indices to get started?
Yeah, sure. So this is just the last 5 days. Of course we did a podcast last week, so it's just the last 5 days. So we got in America, the Dow was up 0.1%. Then we've got the NASDAQ was flat. The S&P 500 was up 1.4%. And then in Australia, the All Ordinaries was up 1.7% and the ASX 200 was up 1.6%. So overall, not too bad of a week. I think is the S&P still pushing all-time highs? It should be, I think. So. Yeah,
I was going to say, I think it hit another all-time high this week. So it's continuing to push on. But
you know what they say, stocks are going up and up and up. This must be a really good time to invest.
Yeah. Time to throw all your money in.
I'm literally going to put all of my available cash in the market right now because, look, the trend is your friend, man, and it's just going up and up and up.
Yeah, well, I mean, honestly, this month has been a great month for my portfolio. It's been very good.
That's the one thing I hate about talking about, individual businesses and margin of safety, and then that one person comes through and comments, yeah, but I invested heaps last month, and look, I'm up like 10%. I'm like, But one day you'll be down 50%.
And then who will be laughing?
And then, yeah. Nobody, because we need the stocks to go back up again before we're laughing. Anyway, so indices, going all right. Very high markets at the moment, as per usual. So should we get into some news? We got first news story here. Microsoft has become the world's most valuable company in today. This is from a couple of days ago. This is on Thursday. But it says Microsoft has become the world's most valuable company in today's stock market trade, hitting a market cap of $1 trillion. Man, imagine counting to 1 trillion. That'd take you a while.
It kind of amazes me that Microsoft. I feel like Microsoft is kind of flying under the radar.
Yeah,
go on.
No, I was going to say the exact same thing. There's like all this drama around the other big companies, Apple's or Amazon's or even like Facebook and that sort of stuff. But totally right. Microsoft, you just don't really hear much about it. It's totally flying under the radar.
Yeah, I mean, certainly I hear a lot more about Apple and Amazon, about them competing for the top spot, a lot more than I hear about Microsoft. But Microsoft are doing some good things, especially in the cloud services space.
Sure.
They're growing their market share in that industry, and I definitely feel like they're flying under the radar.
Yeah, I wish I knew more about that. I just don't know enough about the cloud stuff yet. I think it might be one of the next things I focus on researching. I just don't know enough about it. But anyway, moving on with this news story. So it says Microsoft hit the $1 trillion mark on Thursday for the first time, becoming the third tech giant to reach such a milestone. What are the other ones? Was Amazon? Amazon and Apple, wasn't it? Yeah. So it says shares rallied to $130.59 which helped them hit the $1 trillion mark before kind of dipping back slightly. Yeah. Oh, last year it was Apple and Amazon that hit the 1 trillion mark before they slipped back. So there you go.
It's going to be very strange when, I guess, in maybe 10 or 20 years, when there's a lot of companies that are in that over the $1 trillion mark. It's going to be really strange. I'm definitely going to remember this time when Apple, Amazon hit it for the first time last year, and it was kind of this amazing milestone.
Yeah, it's a good little history marker when we'll come back and say, do you remember back in 2019 when there were only 3 companies that had ever hit $1 trillion? Now it's like every company in the world's hit $1 trillion.
Back before the Young Investors podcast was the biggest investing podcast in the world.
Don't you remember when we only got a couple of thousand views per podcast? Oh, back before the millions. Anyway, so that's that news story. Let's get into... I can take us through the next one as well. We've got the Australian Bureau of Statistics reported that the change in consumer prices between the start of January and the end of March was 0.0%.
Hooray.
So, yeah, good. It's good, right? No inflation. Get around it. No inflation. Jeez, I love living in a country with no inflation. But if you don't know, well, you probably do know, inflation is kind of this weird thing where you obviously don't want it going up too fast, because then people's money loses value very, very, very quickly. But you definitely don't want it going backwards, which is deflation, because then it basically makes sense for you to not spend any money, because if your economy, or if the consumer prices are deflating, then it just means that if you hold your money, then the prices are likely to get cheaper in the future. So it's actually encouraging you to keep money out of the economy. Which obviously further prevents any sort of economic stimulation. So that can actually be... Deflation can be quite dangerous.
It's terrifying. It's actually terrifying that for the first 3 months of this year, we've had zero inflation, because while inflation is a scary thing and it's been very high in the past, it was up in the 15% range in Australia and in the US in the 80s. We have these sort of tools that we can use to reduce inflation. We can increase interest rates, and that's what the central bank does. They increase interest rates, and that reduces the incentive for people to spend as much, so that reduces inflation. But when it comes to deflation, we really don't have too many tools for getting out of deflation. So if we get into a bad cycle of prices going down, as you said, it just makes sense not to spend. It makes sense to save. And that can be really scary.
Yeah, and essentially that's like... So the central bank, or the Reserve Bank of Australia, one of their main jobs is to control inflation, or to try and keep inflation in like this slowly, I don't know, like the kind of 2 to 3% range.
Yeah, within their inflation target.
Yeah, exactly right. The problem here, as you're talking about, is that the RBA, right now in Australia, we've got a record low interest rates of just 1.5%. So it's like, how much room have you got to move to lower interest rates even further to encourage more spending, so more like economic growth? But they're also talking, this article that I was reading, it's essentially, it says that, if they cut interest rates, that should inspire companies and consumers to save less, borrow more, and spend more. It should, in theory, give the economy an immediate boost, but it may not do much for the real economy, but may just prop up the housing market. And then the article also discusses a second option for boosting inflation, growth, and employment is for the government to stimulate the economy itself by spending. So spending on things like infrastructure or health, or cash transfers like higher pensions or higher welfare payments, or delivering some tax cuts. So kind of, I guess there's like two ways that they could try and dig themselves out of this no inflation scenario. But yeah, it's a little bit worrying, I guess. But
Yeah, I mean, it's a fascinating topic because while you can sort of understand if we dropped interest rates, it makes sense that people would want to spend more because money is cheaper to borrow. But there's also this other effect that happens when interest rates are really low, which we have them at the moment at about 1.5%, is that if the central bank keeps lowering interest rates while they're this low, it can also have the effect where people feel like there's something wrong with the economy, and therefore they stop spending, which means that it sort of encourages this deflation. So towards the end of the very bottom of dropping those interest rates, it can have very little or no effect. So and we've seen that in Europe. A lot of the European countries even are sitting on negative interest rates at the moment.
Yeah, interesting topic that we'll have to follow. And they're kind of our two main news stories for today. So with that being said, we should get into part 2 of the podcast. You want to do it?
Yeah.
All right, let's do it. So part 2 of the podcast, we're going to talk about lots of different companies that have been reporting earnings. We're actually talking about some of the really big US companies, or the talked about US companies, because look, it's just more interesting. It's just more interesting. So the first company we're going to talk about is Netflix. So Netflix released their Q1 quarterly results. Do you want to talk about Netflix a little bit? What did they kind of come up with?
Yeah, so for the sort of core numbers that we like to look at, we've got revenue, which came in for the quarter at 4.5 billion, which was up 22% year over year. We had earnings per share, which was 76 cents, which was up 19% year over year. And another number that is important for Netflix, of course, is their subscribers. How many people are subscribed and paying that monthly fee? And that number reached 149 million, which was up 25%. That's pretty incredible that they're still growing subscribers at such a high rate.
Yeah, and a lot from international subscribers. So you find that for Netflix, their US subscriber growth is not very strong at all. But because they've made Netflix available in so many international countries over the last few years, there's still a really good adoption rate of Netflix in international countries and Australia and like everywhere, like around the world. So, but look at that number, that next number you got to talk about.
Yeah, free cash flow. So free cash flow is negative 460 million, which is horrible. Absolutely. And interestingly enough, management from Netflix, sort of similar to what management from Uber have said, is that they're expecting that for the foreseeable future, for the next few quarters, for the next few years even maybe, their free cash flow is going to be negative.
Yeah.
And they're going to continue to sustain their business by going to the debt markets and taking on more debt and running their business that way.
It's crazy. Yeah, like as we've spoken about before, I mean, this just further confirms that they're definitely following through with this all or nothing plan. They see the competition and they've got to do whatever the hell they can to try and get their original content as good as possible and produce as much of it as possible to just be competitive with like Amazon as well as Disney and all these other ones as well, because it's crazy, like reading through their reports. I read through one of their annual reports, their most recent annual report not too long ago, and just when it talks about this free cash flow, and you know, I almost expect sometimes when you see a number like this, the management team goes on the defensive and tries to say something positive about it. It's just like, oh, free cash flow was so negative, but that's because we produce so much original content and look how many subscribers we've got. But at least they're honest. They came out and they said that, where our free cash flow is going to be very negative for many years to come, and we are going to continue to take on debt because we essentially have to play it this way to try and compete with the competitors that are coming in.
Yeah, it kind of concerns me. I mean, will there ever be an end to them spending this much on content? I just don't see that that's going to be something that would ever happen. No. Why would they stop doing that? And I've seen people make the argument that, well, with the amount of subscribers that they've got, if they just increase the monthly fee by $2 or $3 here and there, then they can generate a significant amount more profit.
Yeah, that's true.
Cash flow.
Yeah.
However, with these other streaming services, and you're going to talk about a survey that was conducted about Disney, with these other streaming services, we really don't know if they're going to be able to lift prices that high, because there's been no competition up until now. But now that there's some competition, especially with Disney's service priced at, what was it, like $7 a month?
Yeah, $6.99, $7, yeah.
Yeah, I mean, that's very low. And if you've got Netflix pushing up to the, $17, $18, $20 a month, just to sort of maintain profitability or sort of keep those debt payments at bay, then you could see some people transitioning over to just switching to other services.
And to be honest, everyone was super surprised when Disney came out and said they were only like doing a $6.99 per month cost. And I think they've done that very deliberately, because I think that Disney are pretty much Disney are coming out and saying, Netflix, we want your subscribers. Yeah. So I think they're trying to really, because that's the thing, is that Disney has this money, so they could run this thing at a loss for a little while just to kill off Netflix, and it really wouldn't hurt them too much. Like Disney is really undercutting Netflix, and the amount of original content they've got is just crazy. So they're really doing everything possible to make Netflix's life very difficult. And I did want to talk about this actually. This is obviously, it's a small sample size in this study, but Streaming Observer recently conducted a survey of 602 Netflix subscribers in order to assess the impact of Disney Plus on Netflix. And they found that 12.3% of respondents indicated that they might cancel Netflix and get Disney Plus, while 2.2% of respondents indicated that they are planning to cancel their Netflix. So overall, of the 14.5% of subscribers indicating they might leave the service, if they actually do, that represents probably about 9 million odd Netflix customers. And the study was showing that represents about 116.9 million a month of potential lost revenue for Netflix. So it also says that, of course, the reality is that obviously many people who threaten to cancel don't actually follow through to do so. But they do report that, even if it's just the 2.2% of subscribers who indicate they definitely will cancel, still represents 1.3 million domestic customers, especially at a time where Netflix's growth domestically in the US is going nowhere. So,
yeah, it's interesting. This is going to be one of the things I'm going to be watching closely, and I've said this a few times, I think, just to see when it does come out, what are people actually going to do? Because you can look at surveys all day long, and they're of course interesting, and they give us an indication, but I'd love to see what actually happens. And yeah, you're exactly right with Disney. Disney, for one, they have cash, which Netflix does not, and the other thing is that Disney has other businesses. So they can run this at a loss while they maintain cash flow in their other businesses. And maybe that will hurt their stock in the short term. But if it results in a lot of people saying, I'm not going to pay $15 for Netflix, I'd rather pay $6 for Disney, then it's worth it. Because once you get them on the platform, then you can start raising the price. And if Netflix can even survive through that, then it'll be interesting. Netflix... It's going to be very interesting because it really is all or nothing. Yeah. It's probably the most all or nothing, like large kind of famous popular stock that is out there at the moment, because it really is. They're either going to go bankrupt or they're going to be massive. Yeah,
and, pretty much.
Yeah,
it's just a big bet. It's a big gamble. So yeah, we'll just have to watch it and see. But I think Disney Plus comes out in November, so we don't actually have to wait all that long before we start seeing what happens. So that's kind of Netflix. That was their quarter. Interesting quarter. Posted some good numbers, but also free cash flow, some questionable numbers. With that said, let's move on into Facebook. So Facebook released their Q1 2019 results, and they pretty much showed that daily active and monthly active users were growing, which is good. A lot of people were saying that's going to stop, but they've continued the growth. So daily active users up to 1.562 billion in Q1 from 1.523 billion in Q4. Yeah. So they're still growing very, very well.
And it's not slow. I mean, that's 8% growth in their daily active and monthly active users. which is year over year. That is.
Yeah,
And
not quarter.
I mean that not quarter over quarter. That would just be insane.
That would be stupid.
It's crazy that they're still growing at such a massive rate. Everyone was saying, not only were people saying that the number of users was going to peak, people were saying everyone was leaving the platform. I don't see anybody leaving the platform. I hear a lot of people talking about it, but they're still growing their numbers. And we're talking about numbers. I mean, they have 2.7 billion people using at least one of their platforms. Which is
it's like a quarter of the world.
It's pushing up on a third of the world.
A third of the world, yeah.
Which is it's just insane to me. It's mind-boggling.
Yeah, it really is. It's hard to comprehend how many people that is. But you're right. You bring up a good point. Just shows you the people that maybe you talk to in your friendship group versus the people that actually understand the business. Because basically, if you hear someone say, "Oh, you should not invest in Facebook because everyone's leaving the platform," that is objectively false.
I mean, this is probably one of the cases where you should just look at the data rather than relying on anecdotal evidence. Because if I relied on my anecdotal evidence, I would probably get the feeling that Facebook was losing users. If I didn't know the numbers, and I had to guess, I'd probably say that based on just my experience with the small sample size that's around me. But clearly that sample size is wrong, or if people are deleting the platform, then they're re-downloading it at another point in time.
So that's kind of daily active, monthly active users. Let's get into some of the financials. So this is where it gets a bit interesting. Listen to this. So revenue was down, 15 billion in Q1 as opposed to 16.9 billion in Q4 2018. But still overall up 26% year over year. So they did actually take, like, quarter over quarter, they took a hit in their revenue. And if you actually look in all geography categories, revenue was down. Average revenue per user, $6.42 versus $7.37 in Q4 2018. Income from operations down from 7.82 billion in Q4 to 3.32 billion in Q1. Net income, Q4, 6.8 billion, and now in Q1, this is the crazy one, net income. Q4, 6.8 billion, Q1, 2.4 billion. So you start seeing these numbers, and again, comes back to understanding the business. You see a net income drop from 6.8 billion to 2.4 billion, and you start crapping your pants, to be honest. But at the same time, you also got to notice, if you actually read through these numbers, there are some pretty big asterisks. And the asterisk after the net income number says includes a $3 billion legal expense accrued in the first quarter of 2019 related to the ongoing FTC matter, as discussed in our Q1 press release. So I'll just keep flying on with this. Essentially, in that press release, what they said is that in the first quarter of 2019, we reasonably estimated a probable loss and recorded an accrual of $3 billion in connection with the inquiry of the FTC into our platform and user data practices, which accrual is included in accrued expenses and other current liabilities on our condensed consolidated balance sheet. We estimate that the range of loss in this matter is $3 billion to $5 billion. The matter remains unresolved, and there can be no assurance as to the timing or the terms of any final outcome. So that, basically what I just said, boiled down into just some basic terminology, is Facebook has set aside $3 billion for an expected fine from the Federal Trade Commission over their privacy violations.
And that's an insane fine, if you really think about that. That's got to be one of the biggest fines from a government ever. I know Google's taken a few big hits from the European Union, and if you probably added up all of Google's fines from the European Union, there'd probably be more than that. But $3 billion in one go, and it could be up as much as $5 billion they're estimating, and it might even be more than that. That's just Facebook's estimate. And Zuckerberg has admitted that he really has no idea when the outcome's going to happen and what it's going to be.
Exactly.
It's a big sort of red flag above Facebook, or sort of a question mark, I should say, above Facebook.
You just have to know. You just have to know what they've done. That they've taken that $3 billion for an expected fine. Like when it does, they want to kind of make sure people understand that it's coming, I guess. But yeah, I mean, that's the thing, and this is where what we're talking about comes back down to understanding the business, because when you look at these Q1 numbers and you like see what was it, net income 6.8 down to 2.4. Then you get a bit scared. But if you understand the business, you realize, okay, they're going to get fined, and that sucks, because $3 billion up to $5 billion, that's a lot of money. But at the same time, the business of Facebook has not changed. So even though they take a big hit and a big fine, their money, their cash producing abilities has not been changed. And that's the way sometimes I just like to bring it back to basics. What is a company? A company at its most basic form is a money-making machine. And the way that they make that money differs from company to company, but really they're just a money-making machine. And in Facebook's case, they're getting fined, but their ability to make money has not changed. They're the exact same company when it comes to making money. So that's where it comes back to understanding the business, because if you didn't understand the business, you'd look at these numbers, you'd crap your pants and you'd run away.
Yeah.
But if you do understand it, you realize, hang on, this is just the same company. It's just copping a fine. And the fine doesn't even put a dent in Facebook whatsoever.
Yeah, exactly right. And another part of understanding the business is understanding the advertising industry, which the fourth quarter of the advertising industry is notoriously a good quarter, because all companies, all businesses ramp up their advertising spending. That leads into Christmas. So if you're looking from Q4 to Q1, it's always going to be negative. You will never see a Q4 that is smaller than a Q1, even if a company is growing.
Same as something like Amazon. The exact same seasonality happens because they get so much cash because so many people are buying stuff on their platform for Christmas that Q4 always looks really good and Q1 always looks really bad. So it's the exact same kind of seasonality that you see.
Yeah, and if you take out that legal fine and you look year over year, so we compare the Q1 of 2018 to Q1 of 2019, then we've got revenue, which was up 26%, income from operations was up 13%, and net income up 11%.
Yeah, so still good growth.
Exactly. They've still continued to grow, and this is through a period where they've spent a lot of money on security, and they've increased the number of full-time staff by some in the 30 to 40% range, I believe it was. They're up to 38,000 full-time staff. So they're spending a lot of money at the moment for things that are going to be useful in the future. And they're, as you know, in the conference call we both listened to, Zuckerberg is speaking a lot about focusing on the private communities that people have online, sort of the WhatsApp and the Facebook Messenger side of things that are not really that monetizable at the moment. And he's going to focus on that, and he's going to build those platforms to be very good. And then once there's, as long as he can secure the audience on there, make sure people don't leave the platform, then we can start to talk about monetizing those platforms. So it's a very long-term game for Facebook, I think. I think if you're looking in the short term, you've got a lot of expenses to worry about, and there's this fine and other fines, and as governments sort of work out how they're going to legislate in this area, there's a lot of sort of things to worry about a little bit. But over the very long term, if they can maintain their user base, advertisers are going to go there. Not only are there the most people on their platform that advertisers love that, but it's by far the best advertising platform. If you've ever used it to run ads, it just crushes everything. It even crushes Google's platform. Google's platform has nothing on Facebook's platform.
Yeah, no, that's true. And I agree with you what you're saying about, it's true that in the next couple of years, there is uncertainty, especially around regulation and the social medias and that sort of stuff. But when you look at the way that Zuckerberg is approaching how he's going to, deal with that, and actually look at the financial position that Facebook's in, it makes it pretty obvious that they're number one and they've got the best shot of anyone to get through it successfully. So that's kind of Facebook. Interesting quarterly results. Lots to kind of take apart and break down. Next up, let's have a bit of a chat around Tesla, because Tesla is going down like a brick. I think a couple of months ago, the stock was at about $350, $370 per share. And I just checked it this morning and it's down to $235. So it's gone down quite a lot. And when I approach Tesla, Tesla's one of those ones that there's just so much going on with it all the time. But the way I like to break it down to make it kind of help it make more sense to me is that they have one core of their business currently they have one core of their business, which is their battery products. Like, that's really what Tesla is. They make really good battery products, and then that stems down to two pathways, which are electric cars and then energy storage solutions for both residential and grid scale applications. So if we look at the quarter results and we first go down the automotive side of things, then you see that in this quarter they delivered, or in Q1, sorry, they delivered 63,000 cars, which is actually down from 90,700 in the last quarter. So out of those numbers, they delivered 50,900 Model 3s and 12,100 combined S and X vehicles in Q1. So definitely less than the prior quarter, but we'll get to why that is. So basically, in Q4 2018, Tesla hit record quarterly revenue of $7.2 billion, like really strong revenue. However, this quarter they only managed $4.5 billion. And again, you can have a look. Last quarter, their operating income was positive at $400 million, but this quarter they posted a loss of $500 million. So it does take a while to kind of wrap your head around Tesla, because Tesla is one of these companies that is moving so quickly and doing so much stuff that their results look very, very lumpy. They can be really strong one quarter and then look very bad the next quarter. So that's kind of automotive. Then if you look at energy storage, they only generated $325 million in revenue in the quarter of energy storage. So that's only like 7% of their total revenue. So, and I should say that usually it's even lower than that. So this area is kind of just in a bit of a holding pattern at the moment, because the energy storage area of their business is completely cell-starved. Essentially, with all of the battery cells that they can get their hands on, those battery cells basically have to go into their cars because that's where the demand is. So, but overall, like, what's interesting about this is that long-term estimates in both energy storage and in vehicle they think that energy storage and vehicle production could actually equate to the same levels of revenue in the long term. So
that's really interesting that it's kind of a supply problem that's restricting their energy storage business, because I believe Musk was saying that the energy business is expected to pick up quite significantly towards the end of 2019.
Yep.
I think he was still expecting it to be a better year than 2018 for energy. Yep. But it's interesting, that at the start of the year they've been having to dedicate more of their resources towards producing those cars.
Yeah, exactly right. Yeah. So overall, it's a bit of a weird quarter, especially because last quarter for Tesla was so strong. But this is what's hard to understand, is there's so many things going on with Tesla. You actually have to pay very close attention to actually understand the numbers when they come out. So Tesla have faced like a lot of challenges specifically in this quarter. So this has been specifically this quarter has been very, very hard for Tesla, and I'll tell you why. So essentially in this quarter, they focus very much on international deliveries, which is obviously much harder because all of their cars are produced in the United States. So before then, it's just been United States sales and deliveries. But this is the first quarter where they've said, okay, we need to get our cars over the seas, literally shipping over the seas to get it to Europe. So they actually say that half of the quarter's deliveries happened in the last 10 days of the quarter.
Oh, wow.
Yeah. So that's the kind of logistical pickle that they were in this quarter. And that's why a lot of times Elon is saying, look, you really should not judge Tesla on a quarter-to-quarter basis. You should judge us on like a year-to-year basis, because we are doing like completely their focus this time around was international deliveries for the whole quarter. So they could have just kept US deliveries going and they could have produced the same number of cars, but they decided that they would focus on international deliveries and get cars to Europe. And that obviously made a huge logistical nightmare for them. And as they say, in the last 10 days of the quarter, half of the quarter's deliveries happened. And what that means, unfortunately, is because it was such a push to the end of the quarter, is that they've got 10,600 cars are still in transit in Europe at the end of the quarter, so they can't be counted as being delivered because they're just not delivered yet. So they've essentially got what this means is they've essentially got a 10,600 car boost to this quarter because they couldn't get those cars finished, delivered in time for the end of the quarter. But again, that's like something that you should, like, as investors, like, the quarter ends at a very specific date. But remember, these companies are just doing their thing the whole year round. Like, it's something to consider. Anyway, that's kind of the first challenge that Tesla had. So do you want to add something there?
Oh, I was just going to say, it's just the classic problem of a newer business, a startup business, is that they don't have consistent production lines yet. So that you really can't rely quarter to quarter to look at how their sort of deliveries are growing, because they're doing it in lumps. And, that, as you said, that 10,000 that couldn't be counted, that's going to be a significant increase on the next quarter when they're counted in the next quarter. So it's going to be all over the place.
Yeah, and what's really interesting is that they discussed in their quarterly results is that a lot of, for their S and X vehicles, they make them to order, whereas in the case of the Model 3, they batch produce. So, for instance, they will batch produce a certain type of, rear-wheel drive, performance, whatever, this version of the car, batch produce it. Then, like, for this instance, they change their lines to make the European version of the car, and then they batch produce that, and then they batch produce that, and then they match up whatever they've batch produced to people's individual orders and paints and that sort of stuff. So I thought that was very interesting. But overall, that is a more efficient way of doing things in terms of getting things built. But at the same time, it does cause these very lumpy kind of, this sometimes fits the bill, other times it just misses the bill, that sort of thing. It's not as kind of a smooth kind of one for one individual basis as like just making them to order. But anyway, moving on. So the next challenge that they faced is that the US federal tax credit halved at the end of the last quarter. So essentially, Tesla had this massive push at the end of last year to pull through heaps of their US deliveries. So they pulled them into the last quarter to help their customers out because they got a better tax credit for it. So that made the US sales very weak, and that's why they decided to do international stuff now, because the tax credit has gone so much, has reduced so much now. Then you've also got the challenge that Q1 is a very, very bad time to be an automaker selling cars in the US due to the fact that sales reduce heaps in winter. It's very seasonal. Then they also, in this quarter, had to retool the S and X production lines in the quarter, which slowed the production. So they actually upgraded the S and X, I can't remember what parts they did. I think it was like the actual motors themselves that upgraded. So they had a period of downtime where they retooled the lines so that they could make better versions of the car. Then the last thing is they also had to pay a $920 million convertible note, taking their cash balance down to $2.2 billion. There's a lot of stuff in there.
Yeah, absolutely.
So many challenges just for one quarter.
Yeah, it's been interesting watching Tesla. I'm way out of my depth understanding this company.
Yeah.
If you're also out of your depth, but you want to hear someone who knows every single thing about Tesla, and I'm amazed by how much this guy knows about Tesla.
He knows a lot.
Go check out Galley's channel, Hyperchange TV. Did you see his earnings video?
I watched it all. Unbelievable.
He makes a 40-minute earnings video at 2 a.m.
Yeah.
Because that's how excited this guy gets about Tesla.
Unreal. And he knows it like the back of his hand. In fact, he knows it better than the back of his hand.
It's insane.
But yeah, certainly. So it's very interesting, like looking at Tesla, a lot of challenges in the quarter. But the more that I research into Tesla, the more I look to the long term, because really people don't quite understand this yet, but they are so far ahead because of their autonomy. It's just ridiculous. Like I watched the Autonomy Day presentation, and Elon was basically discussing how much more valuable cars with full self-driving hardware and software are than cars without. And Tesla is the only car. Teslas are the only cars with full self-driving hardware in them. No other car has that. And they're expecting the software for full self-driving, so full autonomy, like hands off the steering wheel completely. They're expecting that to be done by the end of the year. So Really crazy. And then the thing that really caught my attention, which might be interesting to everyone else as well, being an investing podcast, is they talk about the idea of robo-taxis. So you can buy a Tesla with full autonomy, and then when you're not using it, you can set it to taxi mode or Uber mode, where through the Tesla app, it can just go around and take, customers from A to B, and you'll earn passive income. And they actually reckon that for one Tesla, if you ran it around the clock for a year, you could probably, actually no, not even, if you ran it half of the time around the clock for the whole year, then you probably generate about 30 grand in passive income each year.
That's
so you could
crazy.
you could use it as a passive income machine, and it could literally pay down the cost of the vehicle in the first place. So you basically get a car for free if these numbers hold true. But
if that was true, then there's going to be a huge surge in Teslas.
Huge, yeah.
When sort of the laws start to change and states and governments start to allow these sort of full autonomous cars on our roads.
Because as soon as the governments say that you can have fully autonomous cars on the road, it's a no-brainer. You can buy something that costs $38,000 that will earn you back 30 grand in a year. How's that for a return on investment? That's crazy. But yeah, basically the quote that I took out of it is, I posted it on my Instagram. Basically, Elon says it's financially insane to buy anything other than a Tesla right now.
Yeah.
So, to be honest, like if the laws were in place and autonomous driving was allowed, I would completely agree with him. I think it's just down to regulators. But
yeah,
sorry,
I agree.
I was going to say, I feel like I've gone on a bit of a tangent now.
No, it's a great conversation. It's very interesting, this whole autonomy thing. I'm very curious as to how long it would take a company like Ford or General Motors to produce a full autonomous car. That's something I'm curious about, because Tesla's clearly ahead by a lot in this space, but how much are they ahead by? And that's something I'm curious about, and that's something that'll be interesting to see unfold.
I reckon you should watch the Autonomy Day presentation. It goes for a long time, but that has the answers to the questions that you're asking.
Okay.
They're actually like at least, well, they're very far ahead. It depends. Like if you look at their self-driving computer, the computer that actually does this in the car. They just released their first full self-driving computer, and everyone else is running off of NVIDIA chips, whereas Tesla built their own chips specifically designed for full self-driving. And they were saying that that's a problem for everyone else. The NVIDIA is a great company, but they've got many customers, so they have to provide a generalized solution, whereas Tesla built their chip from the ground up to just be a full... its one goal is full self-driving, so it's completely optimized for that. And Elon, a lot of that presentation, he's just laughing at everyone else trying to do autonomous driving because they're all relying on LiDAR. And he says vision is the way to go. So he relies on vision, like just cameras for most of it. And he was talking about how a lot of people, other companies using LiDAR, it's just dumb because it's not scalable because the LiDAR sensors are so expensive and they're less reliable than vision sensors. So it's just like they're barking down the wrong path.
Yeah. I was watching the first part of that autonomy presentation, and it's so fascinating because I actually invested in a company a while back that was an AI data annotation company. So I completely I said this in the completely wrong order, but Tesla in the presentation was talking about how they take images from the Tesla driving on the road and they have to annotate, they have to label things so that the AI can learn like what's a car, what's a lane, what's a stop sign, and I found that very fascinating because I actually invested in a company that is an Australian company that was the leading company in data annotation. So they had the most data in terms of an AI that like recognized the most images. But Tesla's because they've got such a big fleet. And they've got so many cameras on those cars. They have so much data that they can annotate, and they're clearly very far ahead in this space.
And that's what Elon was again talking about. Another reason that they're so far ahead of everyone else is that everyone else is trying to play catch up by running their full self-driving software on simulated miles. And Elon basically stood up and for 10 minutes just shut them down as to why they should not, or why they cannot rely on simulated miles, and talking about like how clean simulated miles are compared to the real world. He was talking about like how messy the real world actually is. Like he was talking about like in there when they were doing this like data annotation, that sort of stuff, this full self-driving stuff annotation. He's talking about how they had to program to recognize stupid, like absolutely crazy situations that you would never even think possible that the full self-driving computer has to understand, like cars being in the air, like cars being flipped on their head, and like cars being in all sorts of different orientations. They have to recognize like dogs versus like humans. They have to like all of these different basically unsimulatable things. And that's what the other companies are missing out on. That's why Tesla's going to end up ahead.
Yeah, what did he related a simulation, using simulations to sort of correcting your own homework, because if you're building the simulation, what you've built into the simulation is all things that you're already aware of. So you can't have a simulation that has things that are going to surprise you in the real world.
Exactly.
Like he brought up a picture of a truck that was going sideways on a freeway or something. And that's just unpredictable. Or even just a bike on the back of a car. And the Tesla recognized that as two objects, of being the car and the bike.
Yeah. No, that's crazy. Anyway, so we should move
rant.
On. Yeah, massive rant. Trust, like Tesla is so far ahead, it's ridiculous. It's ridiculous. Anyway, moving on to the next one. Here's one, Amazon. Let's talk about Amazon. We got, 3 more to get through? Jeez, we've been talking for a while. That's all right. We've got a few more to get through.
Push through them.
So let's talk about Amazon. So Q1 2019 results for Amazon. I don't really follow Amazon all that closely, but before we kind of jumped into the numbers, it's just worth kind of doing a refresh on Amazon's business, because there are so many parts to their business. There's a lot of revenue segments to understand. So essentially, if you have Amazon and break them down, if we look at their Q1 revenue, 49% of their revenue came from their online store sales. So that's definitely the biggest part of their business. Then 18.6% of their revenue came from third-party seller services. Then 7.2% came from actual physical store sales. This is something that I didn't even know about. I didn't know that Amazon had physical stores, but they do. Yeah. Then 12.9% of their revenue came from Amazon Web Services. Then 7.2% of their revenue came from subscription services, which is actually like crazy considering like they're only a third behind Netflix in subscriber numbers, and being only a third behind and it only makes up 7.2% of their revenue, that's like crazy. But also the last segment is they've got 4.5%, which is classed other revenue, which is mainly advertising revenue. So like if you go onto Amazon.com, then you'll be greeted by a whole suite of ads, and that's
lots
where
of lovely ads.
And that's where that comes in. Did you want to take us through what the results were?
Yeah, so revenue came in for the quarter at $59.7 billion, which was up 16.9% year over year. $60 billion in a quarter. Well done. Well done, Amazon.
Can I have $60 billion in a quarter? That'd be quite nice.
Sure.
Oh, thanks.
I'm still waiting on that Tesla in my PO
You better not
box.
edit that out. I need that. I need that audio clip. He said he would. He said he would. He promised. Anyway, sorry.
Disappointed. Anyway. What else have we got here? So US revenue. So if we go into the revenue and break it down a little bit, US revenue grew at 17% year over year, which was down from 46% last year. So a dramatic decrease in the growth of their US revenue. And if we look at their international revenue, it grew at just 9% year over year, which was again down massively from last year, which grew at 34%. So their revenue is slowing down locally and internationally.
Yeah, it's weird.
But interestingly enough, if we look at some of the smaller segments, such as sort of revenue, their ad revenue or their,
revenue. Smaller segments such as revenue.
60 billion. No. if we look at their ad revenue, or if we look at their their cloud services, then those areas are continuing to grow at high rates. So advertising was growing at 34%, although still a slowdown from the 60+% which they've had in every year in the past 5 years. And cloud services continue to grow at 40%.
Right. Okay. So there's still some definite growth areas in their business, but overall, it's just not growing like maybe what a 200 PE stock should.
Yeah. And I mean, the good thing is that the areas that are growing quickly are high margin areas. So advertising is basically 100% margin. I mean, whatever revenue you bring in is profit. Pretty much, it's probably like 99%. Cloud services has high margins as well. And the reason that total revenue isn't growing that quickly is just because their total revenue is so big and they're bringing in so much money on the top line for their online stores, which really don't have great margins at all. Their margins are probably in the 3% range or something like that for their online stores. They don't make a lot of profit from those. They just generate a lot of revenue from it.
Right. Okay. Right. That makes sense. And I should also say that if you're wondering why we're just using year-over-year numbers as opposed to like quarter-to-quarter numbers, it's because we're going from Q4 to Q1. So Q4, as we were talking about earlier, is a massive, just crazy big quarter for Amazon because of Christmas and all that sort of stuff. So if you actually look over the past however many years and you look at Q4 then onto Q1, in basically every quarter, Q4 to Q1, the numbers go down significantly, and that's just due to the massive seasonality. But so overall, EPS $7.09 versus $4.27, which was expected. So that's a pretty decent beat. And I like what you've written here. Still paying $1 trillion for a company that produces about $15 billion in profit.
And that's generous. That's me. That's forward earnings. That's just me guessing based on
that
what
is
they
you being
produced.
nice.
Yeah. It's pretty incredible because I still get people telling me that you can't look at earnings for Amazon because you can only look at revenue because they're investing so much. And it's just not true. I mean, they are investing a lot of money and that is adding up in some of their expenses, but a significant amount of their expense is just the cost of the goods that they're selling. I mean, if you just look at Amazon's income statement, look at their revenue, and then look at how much it cost them in terms of the goods and in terms of the fulfillment centers. So just the cost of the products they're selling, which are already 1/3 to 50% of their revenue because they're selling physical goods. And then they have these fulfillment centers, which is where they ship out all of their goods. And by the time you've counted for both of those things, most of their revenue is already gone. So that's not investment. That's just cost of sales.
Yeah, that's very interesting. And that highlights the difference between when you sell things like when you sell physical products versus when you sell
advertising.
Non-physical products like advertising, or even you can look at it still like a product. Maybe you're selling software. Yeah. Where instead of having to, obviously this is the problem with things like Amazon and Apple. For Apple to sell an iPhone, they need to make one iPhone. Whereas for Adobe to sell one Creative Cloud subscription, then they don't have to make the Creative Cloud again. They're just selling, copy-paste. They're just selling copies of the same thing. So that's where you can kind of differentiate. And that's why there's been such a shift I guess that's why internet-based businesses have become so flippant popular, is because they're very high profit, high margin, and very scalable, because you don't run into those huge costs of revenue. So if you look at Amazon, you look at revenue versus cost of revenue, they're very close. Whereas you look at Adobe or Facebook and you look at revenue and then cost of revenue is very, very small compared to what revenue actually is, because they don't have to physically make anything.
Yeah, and people who don't listen to people who say that price to earnings doesn't matter, because earnings is what you get as a shareholder. Revenue doesn't matter if none of it's coming down. It doesn't matter what a company produces. It matters what a company keeps at the end of the day, because what the company keeps is what you get as a shareholder. So while it's true that Amazon could massively, and probably will, grow their advertising and their cloud services businesses which have much higher margins, which is why their earnings are starting to actually grow now, where they haven't had any earnings for the past 15 years, basically. That's basically, if they can continue to do that, it's great. But you've got to realize that just because they're bringing in 60 billion in revenue doesn't mean that they're going to, you should be willing to pay, such a huge price for this business.
Yeah, no, I agree. It's pretty Amazon is one of those examples where it's just it's a business that is, I don't know, perceived by many in a very interesting and maybe not conservative way. The analysis is not very conservative when it comes to these growth businesses. Anyway, yeah, let's just fly through because we've been going for a while now. Let's talk about, Microsoft Q3 2019. Do you want to just quickly run through the numbers so that we cover it? I mean, I don't follow Microsoft too much. Do you follow it very much?
No, not really. No. So I'll just go through the main numbers that we look at. So we've got revenue, which came in at 30.6 billion, which was up 14% year over year. Earnings per share was $1.14, which was up 20% year over year. So nice growth in earnings for Microsoft.
Yeah.
Equity has grown almost 15% in the past 9 months, so they're going to see some good equity growth when the full year numbers are out. And free cash flow is pretty stable over the past 9 months, up 4% in the past 9 months.
So definitely not bad numbers there. Pretty decent. Pretty decent. I don't know the context of Microsoft, because I don't follow it all that much. But if you just had a company which was posting those sort of numbers, you'd say, you know what, that's going pretty well.
Yeah, certainly not a bad quarter for them.
Yeah. And last one as well, which I don't really track, but I know you do a little bit, Coca-Cola. Do you want to hit us up with those numbers?
Yeah, so revenue for Coca-Cola in the first quarter of 2019 was up 5% to $8 billion. Earnings per share from continuing operations was 38 cents per share. That's up 24% year over year. And management gained market share management said that they gained market share in the total non-alcoholic ready-to-drink category. So that's kind of the long extended industry that Coca-Cola sits in.
What industry are you in? I'm really interested. What does your business do? What industry? We're in the total non-alcoholic ready-to-drink industry.
So specific.
Yeah, I know. It's like, oh, okay. So what's your business? Oh, we're Coke. Oh.
It's like anyway. They didn't grow in any other market, so they just found the specific market that they grew in. And they were like, yes, this is
it's it. We've actually gained market share in the drinks that come in aluminium cans with red labels.
We've actually Coca-Cola written on them. But...
Yeah, we have Coke. So be as specific as you can. Yeah. Anyway, continue.
Sorry. Free cash flow down 1% to 355 million, and that was just due to higher capex. And sort of maybe the interesting thing about Coca-Cola that's going on at the moment is that they recently released, or they're going to be releasing, their new coffee Coke drink, which is kind of like an energy drink that they're sort of trying to compete in that market. And the reason that it's interesting is that they have a partnership or an agreement with Monster Beverage, which is an energy drink company, to not make an energy drink. So they're having a bit of a legal battle, and Coca-Cola's arguing that their coffee Coke drink is not an energy drink, which that dispute is ongoing. So it'll be interesting to see who wins that. But it sounds pretty much like an energy drink to me.
Yeah, it does sound like one. Because, I mean, coffee Coke, you're just adding sugar and caffeine, which is basically, carbonated sugar, caffeine. Isn't that just what an energy drink is?
Honestly, I mean, there's obviously more. Obviously, it's more detailed in the agreement. So we'll have to see. I mean, that battle's been going on for almost a year now. So,
I was going to say, I think we've mentioned that before. I just couldn't remember, that's all. So, yeah.
Yeah, it'll be interesting to see.
So it's taking a long time to play out.
Yeah, absolutely. And, I mean, that's obviously not good for Monster Beverage if they're allowed to produce that, because Coca-Cola actually bottles and ships and distributes all of Monster Beverage's drinks. So you can imagine that Coca-Cola is probably going to distribute their energy drink a little bit more than the Monster Beverage one if they're allowed to do it. So it's not good for Monster Beverage.
Well, it sounds like if there's a falling out between the two companies, it could be a lose-lose.
It could
Like
be,
it-
exactly. And I think
Could-
it's probably more of a loss for Monster Beverage, though, just because they're so reliant on Coca-Cola
To distribute,
to all of the other places.
Right. Oh, that's interesting. So yeah, okay. So that's Coca-Cola. So there is some interesting stuff going on with Coke. Do you want to just do a couple of Q&A questions and then we'll get out of here?
Let's do it. So the first Q&A
Alright.
question that we've got is, what are your thoughts on bonds, ETBs, bond ETFs as a possible passive income source? Although return is significantly lower than value investing, what would be the best way to invest in bonds?
Right. What's an ETB?
Exchange traded bonds.
Oh, is it? Oh, there you go.
I don't know. I just made that up.
Did you? Anyway. To be honest, I usually don't even look to bonds that much. But to be honest, if I was going to invest in bonds, I'd probably just buy a bond ETF. Because I feel like that's just super simple. Like, I was just looking before, and you can have a look at something like VGB, which is a Vanguard bond ETF that actually tracks the Australian government bond index. But, like, I'm never going to be really that interested in bonds unless they show, like, a really good yield. What do you think about bonds?
Yeah, I don't think, with bonds being so low at the moment, it's just not necessary. I
Yeah.
mean, I just put my cash in a high interest savings account that gets me
Yeah.
2% or almost 2%. And on a 2-year bond, you're probably going to get 2.5%.
Yeah.
So to me, it's really not worth the
And I don't
effort.
I don't want to have to lock my money, like, down for 2 years, especially, like, now. I want to be able to access that money.
Exactly right. And I'm pretty sure especially if you're in Australia, you can definitely find these. You can just find a high interest savings account, which is one of the ones where if you withdraw the money, you don't get interest, so you can't withdraw it. But of course, if the market turns down and you need to make some investments, you just withdraw it, and there's no loss of anything. You just lose the interest for that month.
The interest, yeah, okay, yeah. Yeah, so, yeah, overall, like, I'm not really big into bonds. I've never really seriously sat down and properly looked into them. But yeah, I mean, the yield would have to be better before I kind of consider it. Yeah, okay, second question. How to decide, this is just a topic for conversation, how to decide how much to invest at a time. I think this is a good question, but I think, like, the main thing to do, as opposed to deciding how much to invest at once, you should instead kind of decide what percentage of your income can you put away each fortnight to invest. I think that's a better way of approaching investing, especially if you're a passive investor. You basically just want to be firstly paying yourself first. You want to be following those paying yourself first principles and make sure you commit to a certain percentage each week that you take out of your paycheck and put it into your investing account. Just save up that lump sum and then come back maybe, I don't know, every quarter and then invest it. And then, I don't know, for active investors, I think that there's some stuff that gets talked about. If you've got a great company at margin of safety price, it's true that if it's on like a downtrend, you probably don't want to sink all of your money into it at once. You probably want to invest in chunks, and because hopefully, you know, if it's on a really big downtrend for a reason that's not significant, you could invest at a margin of safety price, and then it could be lower in a month or two, so you could come back and invest even more, and then even more again. So I personally, if I had a margin of safety price and a great company, I probably wouldn't sink all my money in at once. I would divide it up. I don't even know what sort of percentages I would look at. I'd probably make like perhaps 25% of what I wanted to invest I would put in straight away, and then watch it after that. If it goes down further, I'd put in increasingly bigger chunks.
Yeah.
What do you reckon?
Yeah, I don't have any strict rules on how much I invest every time. I just sort of have a couple of guidelines. One is that I always have cash, at least some amount of cash, so that I don't just invest everything at once at any time, so that, as you said, if it continues to fall, you can pick up a little bit more. And the other thing is that I never invest my entire amount that I'm going to be investing in a position at once. So again, so that you want to slowly invest into a position, so that if it continues to go down, you can average down, and you can sort of get an average price over maybe 3 months or a bit longer, maybe even 6 months, rather than just being at the mercy of the one price that you bought at. But besides that, I don't really have any strict rules. I just try and keep my cost down as much as possible. So trying not to take on, more than a 1% brokerage fee when I'm making an investment.
Yeah, true. That's the other thing to consider, isn't it? Brokerage.
Yeah, so that kind of wraps up this week. We've been going for just over an hour. So again, if you're interested in hearing about a specific stock's earnings next week, and they're reporting their earnings next week, then make sure you leave it below in the comment section of the YouTube video, which will be on my channel this week. And yeah, thanks for listening, everyone. Almost said thanks for watching again.
I say that all the time. Thanks for watching our podcast that you're listening to through your ears. Yeah, pretty much. Make sure you leave a like on the video and rate us 5 out of 5 stars. I think we have a couple of ratings.
Yeah, we do. Thanks to everyone who's rated it. No, thanks to everyone for listening again. And of course, we'll be back next week. If you have any questions, leave them below the YouTube comments. And thanks for joining me as always, Brandon.
It's all right.
And we will see you next week.
Bye-bye.
See ya. Bye.
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 Right. Love you too.
I'm keeping that in.